Welcome to this explainer. Let's jump right in, because today we're dissecting a totally fascinating reality about the markets. You see, true trading psychology, it's really not about raw, white-knuckled willpower. Staring at your screen literally begging a stock to go up is absolutely going to break you over time. Instead, true psychology is all about building strict mathematical safety nets around your capital. If you rely on structured risk management, your mindset naturally becomes bulletproof. So let's dive into exactly how we build those nets.
Look, we've all been there, right? You spot the perfect setup, the indicators are perfectly aligned, you pull the trigger, and somehow you still end up deep in the red. So why do even the best setups sometimes end in devastating losses? Well, if your trades are consistently failing, the root cause is rarely your actual strategy. Actually, scratch that, it's almost always psychological stress triggered by poorly managed risk. When you don't have a safety net, panic just takes over the wheel. And panic, it literally always leads to bad decisions.
So here's our cognitive roadmap for the day. We are going to start by fixing your overall psychology, then we'll build a pyramid foundation, run a correlation check, manage our time limits and volatility, apply the golden 1% rule, and finally, look at safety nets and hedging. 6 direct techniques to take your mindset from completely chaotic to perfectly calm. Starting with Section 1, Fixing Your Trading Psychology, the Insurance Approach. Okay, so fixing your mindset requires a pretty fundamental shift. You have to start treating risk management exactly like an insurance policy for your hard-earned money. The absolute easiest way to fix psychology is risk management. Think about it for a second. Why do we go out and get term or health insurance, using great services like Ditto to find secure, spam-free guidance? We do it because it keeps our minds totally calm. When the real-life risk is covered, you're free to take calculated, bold steps. Trading is the exact same thing. The tighter your mathematical risk management, the clearer your psychology. Moving right along to Section 2, Building a Pyramid Foundation by Scaling In. We really want your trade entries to be as structurally sound as the pyramids of Giza. Imagine for a moment just throwing down your full 100 quantities all at once on a breakout. If the market instantly reverses into a fakeout, your loss is massive, and that panic hits you immediately. No way, right? Now compare that to scaling in. You just buy half your quantity first. Boom, your risk is instantly halved. If the trade fails, it's just a tiny paper cut. If it succeeds, you just add the rest on the pullback. It dramatically limits those early losses and keeps your mind completely relaxed. Next up, Section 3, Correlation Check. Context is king. In the stock market, context is literally king, and taking isolated trades in a vacuum is incredibly dangerous. Your mind is going to stay so much calmer when you zoom out and confirm that your individual trade is actually aligned with the broader market. Like, if you're shorting the Nifty index but Bank Nifty is sitting right on a major support level, your trade is probably going to fail. Or imagine buying an IT stock like Infosys when the entire Nifty IT sector is just bleeding out. Making sure the broader industry trend supports your move totally removes the anxiety of fighting against the overarching market current. Which brings us to Section 4, Time Limits and Volatility. Knowing when to exit. Setting strict boundaries regarding time is absolutely crucial. It protects not just your capital, but your mental energy. Enter time-weighted stops. As an option buyer, you're fighting a constant, invisible enemy, Theta Decay. That's the melting of your premium value over time. You might jump into a trade that just goes totally sideways for an hour. Your premium just melts away and your frustration spikes. But by using a time-weighted stop, you make a mental contract. If this doesn't move in my favor within 1 hour, I'm out. Closing it based on the clock, regardless of the price, saves both your premium and, honestly, your sanity. But what if the trade is actually winning? Well, you lock in that peace of mind by strictly trailing your stop loss. No guessing, no hoping. If you're a beginner, just use a line chart to spot structural swing points, simply moving your stop up to the last dip. More of an indicator person? Use the 9 EMA, or maybe the 21 EMA for those really strong trending days. As long as the price stays above that line, you just sit back and enjoy the ride. But the exact moment it closes below, you're out. No emotions, just pure rules. Market speed also heavily dictates our psychological approach, specifically by looking at the India VIX, the volatility index. When the VIX is low, say under 15, volatility is super low. Option premiums are cheap, which means you can safely increase your position size. But if that VIX spikes over 15 or 20, the market is getting wild. Stop loss widths have to be way wider just to survive the noise. In this environment, you must strictly decrease your position size. Trying to trade your normal heavy quantities in a highly volatile market, yeah, that's a guaranteed recipe for a complete psychological breakdown.
All right, Section 5, the golden 1%, your ultimate mental shield.
We have officially arrived at the most crucial, completely non-negotiable mathematical rule for a stable trading mindset. It's the golden 1%. If you genuinely want to survive the markets over the long haul, you must never, ever risk more than 1% of your total trading capital in a single day. Not per trade, folks, per day. This is your ultimate mental shield. Let's just break down the math real quick because it's brilliantly simple. Determine your total trading capital and literally just divide it by 100. Whatever that number is, that is your strict maximum daily loss. If your capital is 10 locks, your daily limit is exactly 10,000. If you lose 10,000 in a day, boom, the trading terminal gets shut down. You don't revenge trade, you don't sit there hoping for a miracle bounce, you accept the loss and you walk away. This single mathematical rule instantly removes all that emotional guesswork and ensures you live to trade another day. And finally, Section 6, safety nets and hedging, protecting the downside. For those larger, way more intimidating positions, we need the ultimate psychological safety net. We're talking about hedging. Hedging is simply taking an opposite position to offset and strictly cap the potential losses in your primary trade. Say you buy a Nifty future, betting the market's going to go up. A sudden, violent market reversal could easily blow right past your 1% daily limit, causing immense panic. So how do we mathematically prevent that from happening? By building a hedging safety net. Simultaneously with your Nifty future, you just buy a cheap, out-of-the-money put option. This put option acts as pure insurance. Your upside remains completely open, meaning if the market skyrockets, you still profit. But if the market unexpectedly crashes, the value of that put option absolutely explodes upward, offsetting the massive losses on your future. Your downside is now strictly capped. Even during a total market meltdown, your mind stays perfectly calm, simply because you already knew your absolute maximum possible loss before you ever even clicked buy. So as we wrap up this explainer, I want to leave you with a really critical question to chew on. Which safety net is missing from your next trade? Are you actually scaling in? Are you checking your correlations? Are you strictly obeying that 1% rule? Or are you just flying blind, relying on sheer willpower and hope? Take a step back, review your strategy, implement these strict mathematical rules, and just watch how quickly your risk management psychology transforms from anxious to completely unstoppable. Thank you so much for hanging out with me today, and I'll catch you in the next explainer.